Now we're going to get down to the more important information, which is the underwriting analysis report. So the recommendation again was approve eligible. The borrower's name is here, the loan number is here, the submission date, co-borrower's name should be there once there is a co-borrower, case file ID, and the DU version. It'll have the property address where it says property information, the property type. Number of units in this case is 1. Very important, occupancy status, primary residence. Now, when it's an investment property or a secondary home, this will affect the approval because you need to make sure that the loan to value is not higher than a certain percentage so that the loan is approved by DU or LP. Further down where it says mortgage information, the loan type. This is a Federal Housing Administration loan or an FHA loan. And most loans with FHA will require a minimum down payment of 3.5%, and that's why we have a loan to value of 96.5% over on the right. Pretty simple. There's a rundown of what the terms of the loan are. The amortization type, fixed rate. Balloon, no balloon here. Community lending, no. Payment frequency, monthly. And the lien type, this is a first mortgage. If there's any subordinate financing, no, 0. Loan purpose, purchase. All the way on the right, we'll have the loan amount, which is $279,850. The financed MI or mortgage insurance amount is $4,897. Now, this is the upfront mortgage insurance that's paid when you have an FHA loan. A little bit further down where it says total loan amount will be $284,747, which is the sum of the other two numbers, the $279,850 and the $48,97. The purchase price is $290,000 and the appraised value is also $290,000, or at least that's what's being assumed. Remember, this is a to be determined property address, so no appraisal has been completed yet. This is just assuming this information. The principal and interest, or P&I payment, will be $1,193.76, and the note rate that we're using to qualify the borrower is 2.956%, and the qualifying rate is the same, 2.956%. Owner existing mortgage, nothing. Buy down, no. Bought down rate, 0%, because the borrower is not buying down the interest rate. The terms or months, or the term of the loan in the months is 360 months, which is the same as a 30-year fixed mortgage. Income. This is where we go over more important information so that you can analyze why sometimes the ratios are higher than what you initially calculated. So the base income is $42.26 here. There's no commission, bonus, overtime, or other type of income. So the total is $42.26 or $4,226. The housing expense ratio is 46.07%, and the total expense ratio is also 46.07%. Any expense ratios? 0. Now, the proposed monthly payment. This will include any HOA fees, mortgage insurance, taxes, hazard insurance, second mortgages, and anything else that needs to be included here. Sometimes there's flood insurance or any other type of insurance that also will be here. So let's go over these real quick. So first, the principal and an interest qualifying payment is, as we saw just a minute ago, $1,193.76. The estimated hazard insurance that we use to qualify this borrower is $150 per month. This will be different depending on the age of the home, the area where you're purchasing, and the insurance companies in the area and the state where you're in. But this was what was used to estimate for this borrower. In terms of property taxes, it says $400, and that's also an estimate. The mortgage insurance, the automated system, when we figured out or calculated the borrower's monthly payment when we saw the interest rates, was $203.09. There are no HOA fees or homeowners association fees, and there's no other fees. So the total housing payment is $1,946.85. The total expense payment is $1,946.85 once you add all other payments. So in this case, to be able to calculate the total expense payment, you would have added car payments, credit card payments, student loans, and any other payments that appear on the borrower's credit report to come up with the total expense payment to be able to calculate this ratio and be able to use this income to find that ratio, the total expense ratio. Now, when it comes to, that was income, Now, when it comes to assets, the funds the borrower is required to have and how much they actually have. This is how you read this area. So basically, this is what the borrower is required to have, $13,615, and what they have, or what they've put on the 1003 that they have in their bank account, is $14,000. Okay, there's no cash back to the borrower. Net cash back, there's no net cash back to the borrower. And reserves, we have $385, which is basically when you subtract $14,000 from $13,615, this is what is calculated in terms of reserves. Monthly reserves, it says 0 because it's not enough to cover even one of these payments, the $1,946.85. Sometimes when you can't get an approval, you can increase the reserves by simply including more of the borrower's assets if they have a retirement account, if they have additional savings accounts. And if this says, for example, instead of $14,000, it says $40,000, then we'll have more in reserves and we'll have more months in reserves as well, which affects the DU findings. So when you run it through the system, if you initially get a denial and then after that you get an approval, then it might be because you have those additional months reserves. But the most important things that you need to take into account are the total expense ratio. For FHA, you need to stay under 50%. For conventional, right now, you have to stay under 45%. Depending on the economic situation at the time, that can change. You know, it can go lower. Sometimes they'll stretch it up a little bit higher. I remember a few years ago, for FHA, it was 55% or 57%. So they keep changing that. Depends on the risk factors that are currently affecting the economy and the overall mortgage market. Also, so remember, the expense ratios are very important. The borrower's credit score is very important. And their assets are very important. Those three things need to be in line. You have to maintain or be able to provide the minimums for each one of those so that you can allow the borrower to qualify. And then down here it says, the recommendation for this case is approve eligible. If you get any other status that's not approve eligible, you can't submit it to underwriting. If it says approve ineligible or refer eligible, those are not valid status. You need to have an approve eligible status. Just as a disclaimer, they go ahead and include this line that says, notice, DU underwriting findings report does not constitute an approval or denial of the loan application. Lenders must comply with all laws and regulations, including those related to privacy and non-public perso. Now, basically this means that they're not liable if they approve the loan and then the underwriter denies the loan when you send it to the lender, because each lender has their own set of rules and their own set of overlays that they can put or additional rules that they can add. And because the underwriter has to go over additional things to make sure that the loan still complies besides the general numbers that have been provided now. So I know this was a lot of information that you saw right now. And the first time you go over the findings on a DU report, it can be overwhelming. But the most important things you need to take into account is the beginning numbers and make sure that you have an approval eligible, and these last numbers all the way at the end. So the top page, the very first page, and this is page 7 on this report. So this is usually the last page. So you need to make sure you master these and you're able to read exactly how much the borrower is required to have. So for example, if you would have put that the borrower is required, if here you would have had $13,615 are required, but in terms of what's available, if they only have $7,000, and then you're wondering why the loan was denied or referred, you know why. Because they don't have enough money in their bank account. And they need to either get a gift of funds, or they need to get a co-borrower that does have enough funds, or find another solution to make the loan be able to happen. We'll continue going over more examples now.